All right, let's get right into it, because what we're talking about today might just be the single biggest oversight in the EV market this year. We're looking at how one company pulled off a nine-figure profit after years and years of losing money, a huge turning point that pretty much everyone on Wall Street just missed.
For the longest time, the story about NIO was brutally simple. They were labeled a cash incinerator. The accepted wisdom was that it didn't matter how many cars they sold, they just burned through cash like there was no tomorrow, quarter after quarter. That was the narrative, plain and simple.
And then this number hit the books. A net profit of $260 million in one quarter. This wasn't just a little surprise. It completely shattered the story everyone thought they knew.
So, that's the big question, right? How does a company go from burning cash to basically printing it overnight without anyone seeing it coming? Well, the answer is hiding in a couple of key clues that, once you put them together, show a massive shift in how their business actually works.
All right, so our first clue, it all starts in the last few days of the fourth quarter. It's this tiny little window of time, just 11 days, where something pretty incredible happened.
Just look at the velocity here. Look at that jump. In just those last 11 days, NIO's deliveries for the quarter shot up from around 30,000 cars to a whopping 40,000. That's an extra 10,000 cars in less than 2 weeks. I mean, that kind of acceleration is just wild. To put that into perspective, we're talking about a pace of delivering somewhere between 900 and 1,000 vehicles every single day. The logistics behind that alone are a huge accomplishment. But hold on a second. Can you really make a $250 million profit just by selling more cars? Usually, a sales rush like that absolutely kills your margins.
And that is where we find the next piece of the puzzle, the one crucial detail that the analysts completely missed. You see, it wasn't just about how many cars they sold. It was all about which cars they sold.
So, here's the kicker. That 10,000 car surge, it wasn't just any old car. It was almost all their flagship ES8 model. And why does that matter so much? Because that car, that one, has the highest profit margin of anything they sell, by a long shot.
And this really shows you what a huge difference that makes. It's one thing to sell 1,000 cheap cars. You make a tiny bit on each. But selling 1,000 of your most expensive, most profitable model every single day, that just fundamentally changes the entire economic engine of the company. It's the difference between scaling a discount store and scaling a luxury brand.
Okay, so the theory sounds good, right? A flood of high-profit cars. But do the numbers actually add up? Let's follow the money and see how they actually did it. First up, revenue. All those deliveries, a record 122,000 of them, pushed their revenue to a record high. We're talking about 30.5 billion RMB, which is about 4.35 billion US dollars. A new record.
Next, gross profit. Because so many of those sales were the pricey ES8, their overall gross margin jumped to about 16.5%. Now, in the car business, where every penny counts, that created a huge cushion of about 5 billion RMB in gross profit. Okay, in this next part, this is probably the most important piece of the whole story. While all that money was pouring in, they kept their costs, R&D, administrative stuff, they kept it locked down and stable at around 3.2 billion RMB. And that's how we get to the final number. You take that big 5 billion RMB in gross profit, you subtract the 3.2 billion in costs that they kept under control, and what are you left with? A net profit of 1.8 billion RMB. And there it is, your 260 million US dollars. And I really want to stress this point. This is real profit. We're not talking about some weird adjusted number or some clever accounting trick. This was a real, fundamental shift in their profitability, based on standard accounting.
So the math for one quarter works. But the billion-dollar question is, can they keep doing it? Because one good quarter doesn't erase that whole cash incinerator reputation, and that's where their long-term strategy comes in.
The thinking is, yeah, they can, because of what's being called their three-engine strategy. Engine 1 is that ES8 cash cow we just talked about. It makes all the profit to pay the bills. Engine 2 is their new Envo brand, the volume beast. The whole point of that is just to keep the factories humming, which drives down the cost of building every car. And then you've got Engine 3, Firefly, which is all about grabbing new customers at the lower end of the market for future growth. See how it all fits together? Margins, costs, and growth, all covered. When you lay it all out like that, it seems kind of obvious, right? So let's circle back to that main mystery. How on earth did all the analysts on Wall Street miss this so badly?
Well, it really comes down to this one financial concept: operating leverage. It's basically that magic moment when you finally paid all your fixed costs, your factories, your R&D, all that stuff, and every extra dollar you make from sales goes almost straight to your profit line.
And this is what the analysts got wrong. They were stuck in this mindset that if revenue goes up, costs have to go up right alongside it, keeping them stuck in the red. But the reality was completely different. Costs had leveled off, they were flat, while revenue was just exploding upwards. That gap between surging revenue and stable costs, that's where the profit came from. That's operating leverage in action.
So the big takeaway here is that this wasn't a fluke. It wasn't a one-time thing. This looks like a fundamental structural change for the company, a whole new baseline of profitability. The market just hasn't realized it yet. And look, this isn't just wishful thinking. The analysis lays out a couple of future scenarios. Even in a base case, with about 42,500 ES8 deliveries, they stay profitable. In a better case, with 44,000 or more, that profit just grows. It basically puts anyone betting against the company in a really tough spot.
So that leaves us with one last question to chew on. If the so-called experts on Wall Street could miss something this big, this fundamental, with a company everyone is watching, what other stories are we being told that might be completely wrong? What other cash incinerators out there are just one quarter away from proving everybody wrong?